That's what I'm talking about. 70% dividend yield. What could go wrong? As it turns out, everything, and I guarantee you won't be getting that dividend. You clicked on this video because you want to find out how to assess a dividend stock. Look no further. Let's get stuck in. Number 1. The fundamentals. Before diving into a sea of spreadsheets, yields and percentages, stop and think. Do you actually want to be a part owner of said company? That's what shares are after all, equities in a business. If you think the company will become subject of headwinds in the future, why buy it because it has a nice dividend? One example of this would be oil stocks, which are slowly being weaned out of use, albeit very slowly. This is something that the balance sheet would not show. By no means am I saying oil stocks are a bad investment, but it's always something you need to think about. Number 2. What to look for in a dividend stock. The first thing I would do when analysing a dividend stock is to check the PE ratio. Ideally, I like to see a PE ratio of 7% or less, other than for REITs of course, as they operate differently to your typical companies. The second thing I usually check will be the dividend yield. I tend to avoid companies with yields above 8% as they tend to be much riskier or mortgage REITs, but I also like to see a yield above 3%. One thing to note is I would be okay with a lower starting yield, but would expect a good dividend growth and general growth in the future. It really depends on the confidence I have in the company's future prospects. Following on from this point, I would then check the dividend compound annual growth rate, or dividend CAGR for short, to get a grip on how much the business is increasing their dividend and if they are doing it consistently every year. I would then search up and find a yield on cost graph for the company in question. What the yield on cost graph shows us is if the company's share price is rising too fast and is in turn overvaluing the company. If we know a company is consistently increasing its dividend but the yield is going down as time lapses, then it would be a fair assumption that the company is getting overvalued. The final thing I would look for is an increasing trend in revenues and cash flow. Pretty basic stuff, general signs that the company is growing. Number 3. An example. Let's analyse a stock from my portfolio, AstraZeneca. Fundamentally, I believe the company is great because it provides drugs, things that people need to live. They are working on patenting new ideas and also recently received $100 million of funding from the US government to produce the coronavirus vaccine. Another tick. I've been bullish on them from the moment I started investing and can see exponential growth prospects in the future. With the fundamentals covered, let's dive into the technicals. AstraZeneca's PE ratio at the end of 2019 was 31.55%. Not ideal, but I did buy the majority of my stock during a small dip in the share price, and 2020's forecast PE is expected to be 27.47%, a slight improvement over 2019. The dividend yield is only 2.62% due to a recent spike in share price after the US funding was announced. Bearing in mind the growth prospects and the low volatility of the stock though, it's not too bad a yield. During the past 10 years, the average dividends per share growth rate was 4.6% per year. During the past 5 years, the average dividends per share growth rate was 3.7% per year. Judging by this, we can see that AstraZeneca has a nice dividend yield CAGR, although the dividend growth has been slowing in recent years. The yield on cost graph shows some interesting results. It expresses how the yield was actually rising before the corona crisis, but it reduced as the share price skyrocketed and the company became more overvalued. Revenues are also interesting. We can see AstraZeneca revenues were stagnant for a very long time, likely due to expiring patents, but it seems like they are going on a revenue bull run once again since 2019. Overall, from this information, I would personally conclude that AstraZeneca is overvalued at its current price. Hardly surprising with the current crisis the globe is facing. Okay, let's take a look at another example, Royal Dutch Shell. As we can see, Shell's PE ratio is at 13.25%, much closer to our target 7. Not bad. Shell recently cut its dividend and the share price fell drastically. When the dividend is reinstated, Shell will likely have a nice dividend once again. If the dividends were still active, Shell's yield would have risen exponentially. The company could be considered undervalued because when the dividend is reinstated, it would be the equivalent of about a 7.6% dividend yield. Nice. Shell had been growing its dividend consistently since World War II. It is likely that when the dividend starts being paid again, it will be on a slightly lower floor, so it's hard to comment on its dividend CAGR at this time. Revenues have been more or less stagnant for a while now. This is expected as an established oil giant, which is likely bought primarily for the juicy dividend and not capital gains. I think Royal Dutch Shell are undervalued and a good company to invest in at this point in time. Even though oiling is slowly fizzling out of use, it's the big oil giants that are the predominant investors in clean energy, and it could be argued that everyone should have some exposure to the world's most valued commodity. Exploit the low prices. Number 4. Summary. In summary, I wouldn't personally invest in AstraZeneca at the moment because I believe they are slightly overvalued. Shell, however, looks to be much more promising as the prices are low, and I previously did not have any oil exposure pre-crash. No better time than now. Thanks for watching. If you found this video useful, please hit the like button and click subscribe. It does the channel wonders and spreads the world of investing to more people. If you would like to get a free share up to £100, sign up to Trading 212 using the link in the description and deposit £1 into your account. Thanks again for watching. See you next time.